All right, we're in for a rally after some big bank earning beats. 30 minutes until the start of trading. I'm Matt Miller. Dani Berger still on assignment. She'll be back tomorrow. Open interest starts right now. Coming up, more bank earnings roll in with trading revenue soaring at Bank of America and especially at Morgan Stanley. A parade of data center deals as well as the energy industry rushes to keep up with AI demand and tensions simmer. Cooking oil becomes the latest pawn in the U.S.-China trade war. Stocks to watch today include the banks again, but this time we have big green arrows here. Bank of America up 3.5% after beating expectations on net interest income. Morgan Stanley knocking the cover off the ball with trading revenue of more than $4 billion, beating out Goldman Sachs as has been working to do. And you see Nvidia there also up almost 3%. It's joining a consortium with BlackRock to buy a data center company for $40 billion, the biggest data center purchase of all time, and an analyst raising its target on Nvidia to a level that would value the company at almost $8 trillion in the next 12 months. There's a lot going on. Let's get back to those bank earnings. I want to bring in our Wall Street, Chief Wall Street correspondent, Sridhar Natarajan. He joins us here at the desk. So, Sri, I was looking at the chart of Morgan Stanley trading revenue versus Goldman Sachs over the past couple of years, and they've been trying and trying and trying, and they finally overcame their biggest rival.
And that's important. And I know you don't hold much value to banks beating analyst estimates.
That's true.
But in this case, significantly beat estimates. Notched more than $4 billion in the quarter again, and were roughly $400 million ahead of Goldman Sachs. And that's important because in the last 2 or 3 years, Goldman Sachs has had a stranglehold on this business as the dominant player there. It was a crown that Morgan Stanley held for many of the years after the global financial crisis. And when they lost it, it did hurt inside Morgan Stanley, and it has been a sore point for CEO Ted Pick. So he will have a pep in his step with the numbers out today. But not just that. Investment banking fees up 44%. Great performance across advisory, debt capital markets, equity capital markets, and in their wealth and asset management business, the wealth management business that they love to call the ballast of their business, known for its stability. Revenue significantly higher. They pulled in roughly $80 billion in net new assets, which matches the target they've set, quarterly target that they need to meet to get that roughly $1 trillion in net new assets every 3 years. And pre-tax margin up to roughly 30%. It's something that Ted Pick had promised to analysts and investors when he became CEO. So hitting that mark and staying at that mark will be important.
What about Bank of America? They also came out, I heard Allison Williams on Bloomberg Radio this morning saying the net interest income beat. How key is that?
It is important for Bank of America for multiple reasons. One, the stock has been languishing all year. In fact, has been languishing since the Fed started hiking rates back in 2022. So it will be a big fillip for the bank to be able to beat expectations. Also remember that the thing that has been weighing down on this bank has been its held to maturity treasuries at low rates that has not been a big boon to its net interest income. As those securities start to roll off and they replace them with higher yielding securities, that will benefit NII, and Allison has said that will be a tailwind for the bank. When you match that with some strength in the investment banking business, that will be a big help for Bank of America. And I point this out also because at Citigroup, which is their closest rival, at least in the investment banking space, not JPMorgan or Goldman Sachs or Morgan Stanley, Citigroup had been making some good strides with their new banking head, getting ahead of Bank of America for much of this year, to now post a number in the third quarter where they're significantly ahead of Viz Raghavan's crew at Citigroup. That will make them happy out at B of A.
All right, Sri, thanks so much for wrapping that up. Sri Natarajan talking about the banks, and we're going to get, by the way, also to all the cockroach comments today. From the banks to the AI boom, investors led by BlackRock's GIP agreed to buy Aligned Data Centers in a deal that values the company at $40 billion, including debt. Joining us with more is Bloomberg Tech co-host Caroline Hyde. So, Caroline, I think it's the biggest data center deal ever, and there's a huge consortium with Kuwait and Mubadala joining them.
Yeah, MGX, which is the AI infrastructure investment fund coming from Mubadala. But we've also got XAI in the mix, Microsoft in the mix. Basically, every big player that needs compute or wants to finance compute got in on this consortium about a year ago. And here we have the first deal, $40 billion. Overall, this focus on AI infrastructure has about $100 billion of a pool of capital to put to work. They are targeting Texas in this particular instance, $40 billion. They're buying it from Macquarie, which, of course, is an Australian institution that has been all in on infrastructure of all guises for years, and they've been betting on telecoms, but they've also been betting on these sorts of data centers. And it couldn't come at a more frothy moment in the world of AI, so no wonder they're managing to get this deal pulled off, because everyone knows that really what's going to fail us is a lack of power and a lack of infrastructure, rather than perhaps a lack of demand when it comes to AI.
ASML, it's a Dutch company, right? A lithography company.
Extreme ultraviolet lithography.
There you go. So what's the story with ASML today?
The story is everyone's been wanting in on the most sophisticated side of chips because of AI as well. So you're wanting these lead-edge logic chips as well as memory, and people need the equipment to build them. What's interesting, though, is China kind of pulled forward their demand. 42% of their fiscal third quarter numbers came from China. Now, we know that that's going to tail off in the second half and into 2026. The CEO did a good job at signaling to the market and to analysts, look, China's going to fall away because of the geopolitical moment we find ourselves in, but I've got demand here to keep on going. He says, more broadly, 2026 is going to see sales not fall. He didn't say we're going to have ultimate growth, but he did signal that they're going to be able to make up for some of that lack of demand from China from others. So it's all about EUV, but it's also about equipment more at large. They have the biggest, though, amount of EUV demand since 2023. So that was a really good sign that still the demand is there to keep buying this very expensive equipment.
I'm sure you'll talk about this at 11, but HSBC, Frank Lee there, upgrading his share price target on Nvidia. If it comes true, that would be an $8 trillion company in 12 months.
I'm sure Jensen probably thinks it'll be more than that in 12 months. This is the company that still owns the ecosystem. Yes, AMD's been chipping away and been getting that deal with OpenAI. And yes, you start to see all these other rivals try to come to the fore. But more broadly, if you want the compute, if you want these AI data centers, you're putting $40 billion into Texas, you're getting Nscale doing a deal with Microsoft to keep on building out in Texas. They're offering 240 megawatt amount of compute coming from Texas on top of basically the overall, I think that takes it to 2,000 Nvidia GPUs they're going to be putting to work for Microsoft alone in the next 2026 to 2029. Demand's insatiable. No wonder people are going to try that market cap.
We really are partying like it's 1999.
We are.
Caroline Hyde, looking forward to Bloomberg Tech at 11 o'clock. Now let's get to politics. Tensions continue to simmer between the U.S. and China. President Trump threatened to stop trading cooking oil, buying cooking oil from China in retaliation to Beijing not buying soybeans from us. He posted on Truth Social yesterday saying the U.S. can easily produce it ourselves. And by the way, I think we're talking about used cooking oil. With the latest from Washington, we are joined by Bloomberg senior editor Mike Shepard. Is that right, Mike? Are we talking about recycled cooking oil?
We are talking about recycled cooking oil, and it goes into biodiesel that is increasingly used as an alternative fuel here. This is not a new issue. The Biden administration had tried to take it on, and the Trump administration, when it took office, even took some steps to try to rein in Chinese purchases. But, Matt, it adds to the growing list of issues between the U.S. and China when it comes to trade. We saw earlier this week shipping really burst into the fore as something that is extremely contentious with the two and is being used as another bargaining chip. Rare earths elements, yet another one. Yet with all this noise, Matt, we still do see two things happening that are important to remember. One, officials from both sides are still talking, and they've been having discussions this week here in Washington on the sidelines of the IMF and World Bank meetings. The other is that U.S. officials, for their part, still see prospects for a meeting between President Donald Trump and his Chinese counterpart Xi Jinping at the end of the month at the APEC summit in South Korea. So there is still room for the two sides to reach some sort of an accord. Scott Bessent, at an event earlier this morning, indicated that, look, he will continue conversations with his Chinese counterparts, and he may even meet with He Lifeng before President Donald Trump's meeting with Xi. And Bessent may even go to Asia beforehand, too, to try to set the stage. Whether we get any sort of a real breakthrough this week here in Washington remains to be seen. There is a lot to work through. We'll try to get some more clarity, though, from the U.S. side when Scott Bessent, the Treasury Secretary, and the U.S. Trade Representative Jamieson Greer are set to give a news conference shortly and perhaps offer a little bit more sense of what each side, the U.S. and China, is willing to start giving in order to get that trade deal that both sides are really hoping to reach.
Yeah, we'll be watching that very closely as trade headlines have moved markets over the past few sessions. Mike Shepard there in Washington, thanks very much for your insight. Quick check on what's going on in markets. Feeling a little exuberant today, looking at a 0.7% gain on the S&P futures right now. NASDAQ futures up almost 1%, and Russell futures up more than that, with treasuries at 4 even. Let's get a look at some of the movers on our radar today. Stellantis vows to invest $13 billion in the U.S. over the next 4 years to reinvigorate its business and mitigate tariff costs. We'll be talking about that later on in the program. Dollar Tree projected earnings per share to gain at a compound rate of as much as 15% over the next 3 years. Not sure if that's a great sign for the economy. And TrueCar agreed to be acquired by Fair Holdings in an all-cash deal valuing the automotive marketplace at about $227 million. Finally, Papa John's continues to rise, surging again today on a report that Apollo submitted a bid to take the pizza chain operator private at $64 a share. Private equity is awash in cash. Coming up, regional banks have earnings and ease concerns about the cockroach debate. Details next with Herman Chan. This is Bloomberg Open Interest. Let's get to high interest now. Look at what's making headlines around the world. JPMorgan CEO Jamie Dimon said he will put aside his skepticism of Zoran Mamdani if he becomes the next mayor of New York City. He spoke at a conference in Washington.
I have to deal with the world I got, not the world I want. And if he becomes mayor, so be it. If he becomes mayor, I will call him and offer my help.
Dimon added that he said New York will survive. We survived de Blasio. Dimon also warned of more potential cracks in credit markets, calling them cockroaches following the collapse of Tricolor and First Brands. Blue Owl Capital co-CEO Marc Lipschultz pushed back on those comments in an interview with my co-host Dani Berger at the CASE Summit in L.A.
I guess he's saying there might be a lot more cockroaches at JPMorgan, or I'm not sure I know what he's saying. I mean, it's not a private credit issue. I mean, it's a liquid credit market.
And Oaktree co-founder Howard Marks said his company actually made a profit from investing in First Brands. He said they sensed red flags early and made their exit, a rare feat as some of Wall Street's biggest firms face losses. But months, Howard Marks said, for months, they had seen this coming. Now, Bloomberg Intelligence senior U.S. regional bank analyst Herman Chan joins me at the desk, and I think this is fascinating because Dimon, not only did he say cockroaches, but he kind of threw some shade at private credit, right? Implying that the BDCs, the business development companies that hold these funds, will feel the heat if bankruptcies increase. And Marc Lipschultz was like, not us. Right. We're doing our fiduciary duty. And Mark said, not only did we do our duty, but we actually made money on this trade. So what does it look like from a regional banking perspective?
Yeah, so regional banks kicked off earnings reporting today with PNC, First Horizon, and Citizens. I would say we don't see any cockroaches on the regional bank's balance sheet so far. So far, so good. We actually had a pristine credit quarter so far with net charge-offs down, provisionings flattish, and some early credit metrics like non-performers down as well. That being said, some of the regional banks that will report later in the week, like Fifth Third and First Horizon, will have some exposure to Tricolor and First Brands.
So we have had PNC shares slide in today's market because I guess what? They're paying more for deposits, or that's what their earnings showed?
They really showed a strong quarter in terms of the Q3 numbers, specifically on fee income and capital markets activity. Their fourth quarter guidance actually came down a little bit, disappointing because of the strong 3Q. So I think it's just a matter of having a really robust quarter and then disappointing a bit for fourth quarter results.
What do we know about the others that are out today? Citizens Financial beats. First Horizons also jumping after it beat. So what do we know about those two?
Right. So I think the general theme is top line growth really strong, really driven by fee income, capital markets activity across the three names that we're talking about today. Lending was a bit soft, especially with we were a bit disappointed on the commercial lending front. We'll see how it shakes out for the rest of the names that reports, but overall really solid results all across the board.
I was talking with David George from Baird yesterday, and I noticed when I looked at his coverage universe, he has outperforms on a lot of the regionals and not on the big money center banks. And he told us, that's because those big six shares are pretty expensive right now.
Right. They've run a lot over the past year or so, given the robust trading activity and strong advisory and capital markets growth. The regional banks don't have that much, but they are positioned well for interest rate volatility. And we've seen a lot more M&A in the regional bank space, and that could lift potential sellers as well.
All right, Herman, great to have you on the program. Thanks very much. Look forward to more of your research on Bloomberg Intelligence. BIGO is how you can access that. Herman Chan runs our coverage of the regional banks. Coming up, Infrastructure Capital's Jay Hatfield on whether markets are pricing in the risks of a recent U.S. trade escalation. I will say, when Jay was on last year, when he was on earlier this year, he was making some forecasts that dropped our jaws, but he's turned out to be right the whole time. So here's one investor that got it right as everybody else was running scared. This is Bloomberg Open Interest.
There's a lot of complacency around tariffs. It's clearly meant to last, and I think the market is struggling in terms of how to discount that. And all I can say now is, again, I think when I look at market pricing, when I look at volatility levels, it's far too low relative to the underlying risks that are building around the tariff issue.
That was Citi's chief global macro strategist, Jim McCormick, on Bloomberg earlier. Let's bring in Jay Hatfield. He's founder, CEO, and portfolio manager, Infrastructure Capital. And, as I was saying before the break, you've been coming on here for a couple of years now. And last year, you told me and Katie and Shanali you were bullish. You told us why. You had made an interest rate call of 3.75% of the 10-year. And we thought, maybe you were crazy, right? But it's starting to look real. I mean, we're looking at 4% even on the 10-year. How is this all happening?
Well, the two leading indicators of the economy, which of course the Fed does not use, because that's one of their three flaws, is they're terrible forecasters, is the money supply, and we use M0, but you can use the other ones, and the housing sector. So in a normal cycle, the Fed tightens, the housing sector crashes, and we have a recession. In this case, we never really had a boom, so we're having just a minor recession in housing. And of course, we all know there's an AI boom, but it's not like the internet boom. This is a economy-wide boom, which is even affecting my old sector when I was an investment banker, utilities of all things. So you have the tech spending offsetting the weakness in housing and construction. So we're avoiding recession, but we thought that would weaken up the employment situation, and we had sort of the opposite reaction to the president. We're like, oh, finally they got it right, because it was delayed by 3 months because of their poor ability to detect that. So we thought that would be the catalyst for the Fed to cut, because they're Keynesian, so they care about the labor market, and that's what's unfolded, and that's why we think we will get 3 cuts, even though the inflation data is ambiguous, possibly not available. Well, I guess it's going to be available, but it's going to be ambiguous.
Well, and you have different inflation data, right? Because we're looking at core CPI at around 3% and maybe even over. But you have your own CPI, CPIR, I think you call it. How do you adjust that again?
Well, so this is really, really hard to believe, but the BLS doesn't even update their shelter calculation for 6 months. So it's like we were reporting on the market 6 months ago. It's worthless. And they use renewing rents, versus market rents. So they're 2 years behind. This is why the president calls the Fed too late, because they use CPI-U instead of R. If they had used R, so in other words, just use market rents. There's this thing called the internet. You can look them up. They encompass every single home in the country, and it's real time. So you don't need the BLS to calculate shelter for you. So we just use that number. And so CPI-R year-over-year core is about 1.3%. It's less important in PCE, but it's below 2. So instead of saying, well, I think shelter is going to come down, they should say, well, it's already come down, and we just haven't gotten around to measuring it properly. So the issue with the BLS really isn't their employment data, it's their inflation data is terrible. And it makes the Fed terrible at their job. And that's why we really haven't been focused as much on independence of the Fed, but more on incompetence.
By the way, have you talked to anybody in the administration about this, or anybody in the new BLS management about this? Because I know President Trump follows your research and has, tweeted about some of the things that you've pointed out.
We've had no direct contact, but I do think that not just us, but everyone knows about this. This is not a secret. Malpass has talked about it. I don't know why it hasn't been fixed. I don't know why the Fed doesn't just adjust it themselves. I mean, they can use our numbers, but we're just doing it from the internet. It's a very simple thing to do. So it's just pure incompetence, needs to get fixed. Hopefully the new Fed chair will fix it.
All right, Jay, we're going to hold you over. We got the opening bells next. I know you recently raised your year-end price target for stocks, so we'll talk about that. We'll talk about the potential or the debate about whether or not this is a bubble. I talked with Paul Tudor Jones about that yesterday as well, and the trade war that seems to be moving markets over the past couple of sessions. Jay Hatfield staying with us through the opening bells. A check on futures as we head there. We're looking at gains today as we get more big deals in AI, a $40 billion data center deal, and banks beating, and Morgan Stanley just knocking the cover off the ball with trading revenue. Right now, futures up 0.7% on the NASDAQ, 1%. This is Bloomberg. Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller. We're looking at gains across futures right now, about 0.7% on the S&P. We did fall yesterday on concerns about a cooking oil spat, cooking oil versus soybeans, but only 0.2% on, and in fact, less than 0.2% on the S&P. Ringing the bell at the New York Stock Exchange, Hewlett-Packard Enterprises celebrating a 10-year anniversary of its listing, and the stock has done very well over that time. It's up almost fourfold, and in the last 5 years, it has tripled if you reinvest your dividends. So I always look at total return on the terminal. Not publicly traded, but Interbrand ringing the bell down at the NASDAQ market site. More interesting today is obviously bank earnings. So let's take a look at what's going on. These shares climbing. That's not what we saw yesterday, of course. Goldman Sachs and Morgan Stanley dropped. Sorry, JPMorgan dropped even after beating estimates. But today, Bank of America beats estimates. It's up 4%. Morgan Stanley makes more than $4 billion in the quarter on trading. It's up 5%. And then Nvidia right now, it's up 2% after it joined a consortium with BlackRock's GIP. I think it's going to be called the AAIP, and they're going to buy ADC for $40 billion. It's essentially a data center play with a lot of people involved. Let's go back over to Jay Hatfield, founder and CEO and portfolio manager at Infrastructure Capital. And Jay, let's start on AI because of, this big deal. And every day it seems like somebody else wants to do 10 gigawatts of compute, which is a massive amount of power. I think OpenAI has announced 26 gigawatts of deals in the last couple of weeks alone. Do you think this is a bubble? Because a lot of people have said, in fact, Bank of America put out a survey, 54% of fund managers said they think we are in an AI bubble. Mm-hmm.
Well, I'd say two things about that. First, that's the great thing about the U.S. capital market is we do have bubbles, and that attracts capital into the sector, and we're always first in technology. So I wouldn't be so negative on bubbles, but there's a de facto bubble function on the terminal. So if you hit Nvidia, equity, EEO, go, you can look at 26 earnings and 26 earnings multiple, and then you can switch it to headline growth, and you can see that Nvidia is growing well over 20%. The PEG ratio for the market's about 2, so it should trade at a 40 multiple. So I think there's like another 15 or 20% upside just on a GARP basis, and I'm pretty certain that we will be in a bubble, and so therefore probably Nvidia will trade at a 3 and 4 PEG at some point. But for right now, it's actually like we hold it in our macro hedge fund because it's a reasonably priced company. The only exception is Tesla in terms of the Mag 8. So I would just look at those companies.
Tesla is the only one that looks like a real bubble to you.
Absolutely. It trades at 150 times earnings, and we don't believe in any of their businesses being very profitable in the long run.
All right, so let's put Tesla. Well, no, let me actually hit on that for a second. Tesla has been one that just crushes shorts. I remember when they IPO'd, Corey Johnson used to be on this network all the time, just ripping apart their earnings or lack thereof, and yet the stock continues to climb. Don't you worry about that?
Well, I would never short it. So just to be clear, really Tesla was the first meme stock, and you may like or not like Elon Musk, but a great stock promoter. Financing is secured. So he's always going to have a new business that will probably keep the stock up, but economically and in the long run, it's almost certainly not worth $400 a share.
All right, so back to the rest of AI, because that's where the real money's being made, right? Mm-hmm. And this is what Nir Kesar argues on Bloomberg Opinion, that, it's not just those stocks even. 95% of the S&P is going to grow earnings next year. And these companies aren't leveraged like the companies were in the dot-com bubble, less than 100% debt to equity. And back then it was twice that. And the other thing is we're in kind of a different environment, right? Paul Tudor Jones talks about the fact that in 1999, we had a budget surplus and the Fed was raising rates. Now we're just spending like drunken sailors, and the Fed's cutting rates, he thinks, down to maybe 250 at a terminal rate. Mm-hmm. What's your take?
Well, the way we estimate the terminal rate is, if you look historically, and you can look this up on the terminal as well, the Fed fund rates trades at 75 basis points over inflation. So to assume 250, you'd have to assume 1.75 inflation. By our numbers, we're already there. When the money supply is negative, you're going to have low or negative inflation. So if we get to 175, and the Fed acknowledges that, we talked about that, so we think we're already at 175. So that's entirely possible. That's in range. We're really assuming 275, and that's why we have 375. The 10-year always trades 100 over the Fed funds rate.
It's fascinating that you think inflation is going to be 2%. I guess that's not using the measure that the BLS currently gives the Fed. But I want to talk about the trade war, because that has been driving markets back and forth. And also I teased that we would cover this. President Trump on Friday said he might raise tariffs 100% more on China. That drove us down to the biggest drop we've seen since April on the S&P. Then Sunday he said everything's going to be fine. So we rallied up 1.5% on Monday. Now we've got this cooking oil thing, which is even difficult to believe that we buy that much recycled cooking oil from China, but they're definitely not buying soybeans from us. What do you make of this, and how should traders be paying attention?
Well, one key distinction is there's a difference between tariffs, which we're in favor of because they lower the budget deficit. So we're forecasting that the budget deficit goes to 1.3
But you don't mind that we have to pay that tax, that we U.S. consumers end up footing the bill?
Well, I do, and that's one great thing about that tax is the president can impose it. It would never be passed by Congress. It's going to be unpopular, and probably the Democrats will sweep in the midterms because taxes are unpopular.
Especially regressive taxes.
Right, but he's imposed that, so that's good because that's probably the only way you're going to get fiscal conservatism. But I would distinguish tariffs from trade wars. So with 20% tariff, you can manage that. A third goes to each side, and consumers are a little bit upset, but not that upset. But if you have 100% tariff, you're really disrupting trade flows, and that's terrible. The good news, like we told a bunch of reporters on Friday, that when the market was crashing, well, look, it's bad, but probably stabilized on Tuesday. It actually did sort of the reverse because of those tweets you mentioned. But it's okay to have this overhang during earnings season. I would just be aware of that after earnings peaks in a couple weeks, then people will focus on the trade war. We think it's going to be resolved positively because it sort of has to for both sides, but There's going to be ups and downs. And then, of course, the budget shut down. But none of that's going to be material when you get this type of earnings reports. We think they're going to be really strong. We already saw the investment banks blow it out. We think the tech companies will do well, even beat expectations. So always play, all the cyclical elements of the market comes from earnings season. And so you can be virtually called, even in the short run, like you can make a call on Friday that the market's going to stabilize on Tuesday simply because the big banks are reporting.
All right. I mean, earnings, Nick Kullis from DataTrek points out they've beaten by 8% in each of the last 2 quarters, and it looks like that could happen again. I want to get to the cockroach debate because Jamie Dimon, because you're kind of bullish the backdrop like Bruce Richards, right? And Jamie Dimon is seemingly always worried. Now he says, you see one cockroach, there are probably more. Marc Lipschultz pushing back on that. Howard Marks, proving that they don't have any issues. What's your take?
Well, it's also important to note that Jamie Dimon really runs the biggest bank in the United States. So it's like driving an aircraft carrier. So you have to be conservative. You have to assume everything's going to be terrible. But we have to make money in the markets. And so you have to look, and these were very low quality companies.
First Brands and Tricolor.
Right, which Blue Owl said, but we think it's also true for KKR and other high quality private equity firms. They have high quality counterparties like Harley Davidson. They don't have this small, small low
car
quality
filter maker.
And roll-ups and these sort of low quality companies.
Subprime car loans.
So we think it's because there was fraud. It's not a wide-based credit problem.
Allegedly,
right. Well, it looks like
know.
fraud,
Yeah.
but so therefore it's not a broad-based economic problem. So maybe there's one more bankruptcy, but for the private equity firms, they have higher quality counterparties. In the case of KKR, they only have 10% in asset-based financing. And not that they want to rely on this, it's not even their money. Like this would be their investors losing money. Of course, they don't want that, but it wouldn't really affect their fee stream materially. So it's not like banks where they actually take direct losses. So we think that all the private equity firms are focused on KKR because they're the lowest exposure, highest quality brand.
So you like that? You're buying KKR?
We are, just because that's a great business. Like it's 10 times better than our business because people can take their money out of our ETFs at any moment, cannot take money out of private equity firms. And you need to have these huge brands because CalPERS and other institutions are locking their money up for 12 years. So it's not like we can enter as a competitor. We can compete in ETFs, but we can't compete with these big private equity firms.
Jay, thank you so much for sharing so much of your time with us. I'm glad we got through so many topics. Jay Hatfield there, he's the founder and CEO at Infrastructure Capital. Coming up, big earnings beat across the board in terms of finance again today. But today the stocks are up. We'll discuss the outlook with RBC's Gerard, Cassidy. And happening right now, Treasury Secretary Scott Bessent, as well as U.S. Trade Representative Jamieson Greer, they're holding a news conference. Greer says China's rare earths move is a global supply chain power grab. And Bessent says China can't be trusted with the global supply chain. He says if China aims to be unreliable, the world must decouple. We'll continue to monitor their remarks for headlines. You can also watch the news conference on your Bloomberg terminal. Just type LIVE GO. This is Bloomberg Open Interest. That was... Time now for our top call. Some of the analyst action in focus this morning. First up is HSBC upgrading Nvidia to a buy. The analyst sees room for significant upside in earnings amid the ongoing growth in AI that we report on every second of the day, and raising the price target 80%. That would mean Nvidia, would have a market cap of almost $8 trillion. That is significant. Next up, Guggenheim initiating coverage of Uber with a buy rating, naming the company its top pick in the rideshare and delivery sector. And finally, Morgan Stanley raising its price target on Citi to $134, saying the bank delivered the highest quality beat across the board compared to its peers. Let's stick with bank earnings. Bank America's investment banking revenue beat estimates as deal making surged in the third quarter. Morgan Stanley revenue blew past estimates, as well as trading finally got up and over Goldman Sachs. Let's bring in RBC's head of U.S. bank equity strategy and large cap banks analyst, Gerard Cassidy. Gerard, it's a pretty exciting, I think, week for bank earnings. Yesterday we saw some, I guess, share valuation weirdness with JPMorgan and Goldman Sachs. But today we've got, real movement in, I guess, the trading league tables, right? Because Morgan Stanley had been aiming to get over Goldman Sachs with trading revenue for years, and they finally have achieved it.
Yes, the results, as you pointed out, across the board were very strong for all the large investment banks and the universal or money-center banks that had obviously big investment banking operations. And Morgan Stanley's results do stand out. Not only did they post those strong numbers that you just referenced, but they also put up a return on tangible common equity number of over 23%, which is a very strong number. So across the board, the capital markets revenues for all of the players were very strong. And even in regionals, PNC reported today, and they have a smaller investment banking operation, and their numbers were better than expected because of that as well.
But PNC, it looks like they're paying too much for their deposits. For some reason, the shares fell, at least in the pre-market.
No, that's fair. They had a greater mix of commercial deposits, and those rates were higher than your consumer deposits. And that was part of the reason that you saw some uptick there in the deposit rates. But we should also remember that it's also a timing issue. The Fed cut rates late in September, so the third quarter results don't really reflect the rate cut. And as that rate cut moves through on the deposit side for all banks, including PNC, you'll see lower deposit costs in the fourth quarter and into next year.
By the way, we have PNC year-to-date shares up now, down 5%. You haven't outperformed, so what kind of upside do you see there?
We think there's real strong upside for all the regional banks, and the reason being is our view that the Fed is likely to cut rates another 25 to 50 basis points in the next 6 months, and this will steepen the yield curve, and that will be very positive for regional banks. And not only that, we think loan growth could pick up, particularly commercial loan growth. And regional banks tend to have 60 to 70% of the revenues coming from lending versus the money centers and the investment banks, of course. Then in the money center case, it's closer to 55, 60%. So if we're right that the yield curve steepens and loan growth picks up, regional banks like PNC and others will certainly see better performance in the next 12 months.
Morgan Stanley, on the other hand, up 32% year to date, and you have a hold or a sector perform on that bank. You think, the shares are overpriced at this point?
The challenge for and to be candid, we missed the run in Morgan Stanley, but when you look at the valuations of these companies, they're priced for peak performance, and they're delivering. And so that is, I think, one of the real positives here. The real question going forward is that will the capital markets activity in terms of ECM, DCM, and advisory continue to at this very strong pace? We think it will through the end of the year and into next year, but it's tougher to figure it out, of course, in the second half of the following year, meaning 2026. But if they can maintain, and their peers, this elevated level of ECM, DCM, and advisory, as well as trading numbers, then the stock is going to hang in there. But we got to remember we're near record levels in some of those categories, so it might be tough to surpass that. And the other thing, too, is when you compare the year-over-year increases this year for the investment banks and the capital markets players, the increases have been great. But next year, even with the elevated numbers, the year-over-year increases are, that so-called second derivative, the rate of change, is going to decline for all of these banks. So that's another thing investors have to keep in mind.
Gerard, great to get some time with you. Thanks so much for joining us. RBC's head of U.S. bank equity strategy, Gerard Cassidy. I will mention you've got a buy on Bank America as well. Investment banking revenue there up 43%. It looks like Brian Moynihan is doing everything right. Coming up, Stellantis revealing its plan to jumpstart its battered business in the U.S. We'll have details on the maker of my Dodge Challenger next. This is Bloomberg Open Interest. Stellantis vows to invest $13 billion in the U.S. over the next years in an attempt to reinvigorate its business, mitigate tariff costs, as well as discuss with Steve Mann, global autos and industrial research analyst for Bloomberg Intelligence. I'll start off with a caveat, Steve. You know I love this company because they make my beloved Dodge Challenger. I love the Power Wagon as well. They have, Mopar or no car is a phrase I've grown up with. But they haven't made a lot of things lately, right? They just don't have much to offer out there. I have that F8 green color as well. They don't have a lot to offer out there. So is this going to help them boost their product offering?
Yeah, I mean, look, if you look at the past few years, you step back and you look at the past few years, the company's basically been focusing internally, cost cutting, and that's at the expense of consumers. So, their market share have been down relative to the big three and relative to everybody in the U.S. market. But, with the new CEO, they're changing their focus. They're changing their strategy. We've done a lot of cost cutting. Let's look, outside of the company. Let's listen to our customers and get them what they want. And that's why, we have this $13 billion investment purely focused on the U.S. market.
Do they have a big tailwind, Steve, because of the Trump administration reducing regulations on things like, CAFE standards? Because, yes. Ford has skewed like pro-environment. GM still has a 6.2-liter V8, but Stellantis is all about the Hemi, like the big inch V8 motor. And that was going the way of the dinosaur in the Biden administration.
Yeah, look, that's absolutely correct. Some of the emissions standards have been eased in the U.S. Penalties have been essentially eliminated related to, fuel efficiency and emission. So that's also helping them bring back like the V8 Hemi, which is very popular. But look, Stellantis actually, checks off 3 boxes here with this announcement. First, it's with the consumer. Second is with the UAW. Now they're saying that they're going to reopen the Illinois plant. That's going to make the UAW rank and file very happy with that announcement. They're going to satisfy the policymaker, the Trump administration. With the $13 billion investment, again, purely focused to the U.S. And lastly, the most important is the shareholders. Right, $13 billion. Well, there's argument in terms of, are some of these money already been announced, been already spent? That's not the point. I think the main point here is that they're refocused on the U.S. Their most important, their most profitable market. So with the new CEO, there's a change in strategy, and they're looking to become much more profitable than they are today.
You mentioned Antonio Filosa, the new CEO, met without really any fanfare because it took so long. It dragged on the search. Tavares was such a disaster. Do you think he could surprise us to the upside, Steve? And I've only got about 30 seconds here.
Yeah, it definitely surprised me. I had some doubts because he was at the helm of the U.S. market, the U.S. business, when Carlos was the CEO. But I think it's a benefit now. I see it's a benefit. He's seen everything. He was on the ground here. Now he's making the changes.
All right, Steve Mann of Bloomberg Intelligence, thanks so much for joining us. Look forward to reading more of your research. You can find that, by the way, if you look at Stella, if you look at GM, if you look at Ford, just type BICO GO on your Bloomberg terminal to see Steve's work. Coming up in the next hour, Sarah Ketterer of Causeway Capital joins us. Plus, the president of BlackBerry's IoT business talks about the expansion in, or really the takeover in car software. This company that you maybe never have heard of, QNX, puts its software in 250 million cars. And HSBC's, frankly, just upgraded Nvidia with a price target valuing it at $8 trillion in 12 months. He joins us later in the program. This is Bloomberg Open Interest. All right, 30 minutes into the trading day, looking at green arrows on the screen. Welcome to Bloomberg Open Interest. I'm Matt Miller. Dani Berger is on assignment. We are going to hear from her in this hour, and she'll be back tomorrow. Coming up, more bank earnings roll in with trade revenue soaring at Morgan Stanley. Bank America killing it in investment banking. A parade of data center deals continues with the biggest one of all time to buy a data center at BlackRock. And Blue Owl Chief Marc Lipschultz pushes back on Jamie Dimon's comments about cockroaches in the kitchen, warning that at his house, everything is spick and span. We begin, though, with stocks rebounding. I caught up with Jay Hatfield of Infrastructure Capital earlier on his views of the AI bubble debate.
That's the great thing about the U.S. capital market is we do have bubbles, and that attracts capital into the sector, and we're always first in technology. So I wouldn't be so negative on bubbles. And I'm pretty certain that we will be in a bubble, and so therefore probably Nvidia will trade at a 3 and 4 peg at some point. But for right now, it's actually like we hold it in our macro hedge fund because it's a reasonably priced company.
Joining us now is Sarah Ketterer, CEO and fundamental portfolio manager at Causeway Capital Management. Sarah, what do you think about this debate? I mean, Jay was saying, look, they trade at 40 times earnings. That's not massive. And he doesn't think any of the Mag 7, other than Tesla, are in a bubble right now.
The bubble debate, we could be tail chasing on that one. But think about what our responsibility is as investors of institutional and mutual fund capital. Like, we need to be in the markets every day. And there are, from the bottom up, still plenty of opportunities globally. So even if the U.S., and I will stick with the U.S. because that's where the concentration is of large weights, and that's not true outside the U.S., but bubble or not, if it has a pullback, there's still places to go to get great upside with companies that are delivering for shareholders and where managements are focused on return.
Well, and we could still see massive upside. I mean, Paul Tudor Jones was on the program yesterday. He says this October feels a lot like October of 1999. And of course, you had a doubling of at least the NASDAQ into March of 2000. But I don't want to be in the market at all if it's March of 2000. So how do you avoid that?
Market timing is, in my view, near impossible. But what you can do is lower your portfolio risk. And that's one of the reasons why in Causeway's international and global strategies, we've been adding more healthcare. It's been out of favor because information technology and financial services have dominated performance almost in every developed market, especially the U.S. year to date. So if you get more healthcare, you get a little bit more defensiveness, lower the portfolio market sensitivity or beta, take some cyclicality out, and there are great companies in that sector waiting to be bought.
We do see some pretty great companies reporting today. I continue to be blown away by the 43% gain in investment banking at Bank America. I think a 35% gain in trading over at Morgan Stanley. We had we're going to talk with Allison Williams in a moment about banks, but we had a slew of great earnings from them yesterday. What do you think about the big banks and the regionals, for that matter, in America?
Well, the banks appear to be in very good shape, and net interest margins improving. A lowering of rates may be quite useful for them, as in other sectors. But there is this focus on credit, and we do need to be careful. We've seen some smoke, and whether there's fire after that, unclear, but it's usually the case. So that's something we're watching. But what I'd note about financials is their prices have moved. So yes, their earnings are coming out to be really good. And this is true globally, even in Europe, where banks have returned a lot of capital to shareholders. Their share prices have already reflected a very rosy future. So that's why they might not be an ideal place to be adding capital at present.
What about, I mean, we've been talking with you U.S. specific here, Sarah, but broaden it out to global. We've had some real outperformance in Europe. We've had some real outperformance on the Hang Seng. We've had some real outperformance in EM. Does that continue?
Part of that outperformance has been propelled by currency, meaning a weaker dollar, stronger foreign currencies. And we see, given the fiscal constraints in the U.S. and the political wrangling, we could, to the degree that has a dampening effect on U.S. growth. We could see that continue. That's very hard to call. But what I can say for sure is that our team at Causeway are finding companies that are working hard to improve returns. In a way, the fact that there's less perfection outside the U.S. means there's more opportunity to see improved performance, and that's across most sectors. So yes, non-U.S. developed in a stock selection context, in our view, is very attractive.
What do you think about central banks? I mean, in the U.S. and globally, it seems that most bankers are bending over backwards to cut rates, ignoring inflation risks and just hoping to, I guess, shore up labor markets, but also inflate their way out of debt.
Well, Matt, the central bankers are in a very difficult position. And you think about Japan, where a rising interest rates becomes untenable when it comes to debt service. So there's really only so much, and that economy is still very fragile, given its aging population and other constraints. There's really only so much they can do, despite the fact that inflation's running a little high there. The central banks, I think, are in a wait-and-see mode and data-dependent, but they're in a tough place. And my guess is, to your point, they'll likely err on the side of being more accommodative, because that's also very politically palatable.
Sarah, great to get some time with you. Appreciate your intel. Sarah Ketterer there of Causeway Capital Management. Let's get a check on what's going on in the equity indexes right now. You still see gains, in fact, pretty strong. 1% and change on the S&P 500 to 67.16, so back in record handle territory. NASDAQ also up 1.25% at 24,882 as we get an upgrade to Nvidia. In fact, let's take a look at some of the individual stocks right now. Nvidia itself up 1.5%. As we've been talking about, HSBC upgrading this company to a buy, but more significant than that rating is Frank Lee's price target on the company, an 80% increase from here. So I think $310 is the price target, valuing the whole company at almost $8 trillion. Frank Lee from HSBC is going to join us later this hour. Shares at Papa John's are rising on a report that Apollo Global Management submitted a bid within the last week to take the pizza chain private at $64 a share. You can see it's trading at 53, so investors still aren't 100% sure of this, but one thing we do know is that private equity is awash with cash worldwide. So they're buying everything that's not nailed down. Bank of America earnings beat estimates as that buying boosted profit. Investment banking up 43%, the revenue there, higher than expected. Morgan Stanley's revenue and trading came in also much higher than expected, at more than $4 billion for the quarter, and finally beating out Goldman Sachs. They've been looking to leapfrog that competitor for years. Let's bring in Allison Williams on that. She's the director of research for Bloomberg Intelligence, and she has a particular focus on the banks. Allison, I rely on your intel for my view of this sector, and this quarter it just looks pretty amazing.
Yeah, I mean, we knew that capital markets was going to be the star of the show, but we are looking at more of an ensemble cast, if you will. Trading and fees, really strong numbers there, 20% growth across the biggest U.S. banks. But also the net interest income story. We're seeing improvement in net interest income. We saw Wells Fargo hold their guidance. We saw Bank of America nudge up to the higher end of the range. That's a positive. We're seeing loan growth. On the credit side, you know, despite some of the headline commentary, the numbers are very good. And so at JPMorgan, we did see, was the one bank we saw their provision a bit more than expected, but we think the more important number there is look at that credit card credit quality. They actually guided down the charge-off rate, which means that credit is coming better than expected. And that's based on the delinquency trends. Bank of America today, delinquency improvement across the board. So really seeing a lot of strength.
So charge-off rate, that's one of those phrases I might put into Investopedia to figure out exactly what you mean. But the loan loss reserves I saw at Morgan Stanley were reduced to $0.
Right. And so Morgan Stanley, I mean, the returns there, what a quarter. They, best in class returns, leading equity trading, as you said, for the first time in a couple of years, leading equity fees, wealth flows. People really own that stock for the wealth business and really showing strength. So obviously they're benefiting from a very strong capital markets environment. We had global equities hitting a record, record market cap. At the end of September, also early October. So the environment just continues to look good. Obviously, we know volatility, can arise, especially in October, but that tends to be good for trading. So.
But is $0 too few of those? Because, Jamie Dimon says he sees some cockroaches, and where there are, one or two, there usually are more.
So we would hope to see, if we're going to see $0 at anyone, it would be Morgan Stanley, because they really don't have a big lending business, right? So they do some business as a benefit to their very high net worth clients. But for credit, the companies that we're really looking at, JPMorgan, Wells Fargo, Bank of America, obviously, as well as Citigroup, the trends are positive. Credit card tends to be a leading indicator. Those trends are very strong. Jamie Dimon pointing to the fact that we've seen, a couple of issues arise. Could there be more? Probably. But the fact for the banks is that the earnings power, right? So we look at, we call it pre-provision net profit. So we're looking at net interest income plus fees, subtracting out the operating expenses. And that trend is so strong that they can absorb some uptick on the credit side. And credit, we've been looking for normalization for a long time. We're starting to see some of that. But really, the banks are well prepared.
And in terms of the share value, how punchy is that valuation? Because we were talking yesterday about return on tangible equity. That's looking good. Price to book also pretty high.
Right. So, financials it's a cyclical business. And as I said, we are seeing a lot of strength in the markets. In fact, it's interesting, some of the commentary you heard from the CEO is just talking about a lot of the exuberance that we're seeing in the market.
Buying their own shares back. JPMorgan was like, we don't really love to pay this much, but.
Right. And when you hear comments like that, obviously it gives investors pause, but the returns are strong. As I said, the market in general, there's a lot of positive sentiment. Things will turn if people start to get worried about recession, right? So recession, that is the key risk for next year. As I said, the banks are well prepared. This is not going to be the global financial crisis. They're less levered. They have good reserves. They have been much stricter in their underwriting. So I think if we go into a recession, obviously we will see losses rise. We will see sentiment turn. That's not good for the banks. But from a fundamental standpoint, they're, as I said, they really have a strong run rate on profit and really set to absorb some of these higher costs.
All right, great to get some time with you. I know you're super busy. Not only today and this week, but always. She's the boss here. Allison Williams runs research for us at Bloomberg Intelligence. You can find her work by typing BIGO on the terminal. Coming up, Blue Owl Chief Marc Lipschultz is pushing back on Jamie Dimon's cockroach comments. We'll bring you more of our interview with Dani Burger next. And House Speaker Mike Johnson, as well as other GOP leaders holding a news conference. We'll continue to monitor their remarks for headlines. We're in day 15 of the shutdown. So if you care, type LIVE GO on your Bloomberg terminal. This is Open Interest.
Alex Padilla are gleeful about this government shutdown. They agree with Chuck Schumer when he said very candidly just a few days ago, every day of the shutdown gets better for us.
Let's get to high interest now. Look at what's making headlines around the world. Treasury Secretary Scott Bessent says China's vice commerce minister may have, quote, gone rogue after using incendiary language about trade. He told reporters China does not want to be an agent of chaos on global trade. Earlier, he also said, as far as he knows, President Trump is a go on meeting President Xi later this month. JPMorgan CEO Jamie Dimon says he will put aside his skepticism of Zoran Mamdani if he becomes the next mayor of New York City. He spoke at a conference in Washington.
I have to deal with the world I got. Not the world I want. And if he becomes mayor, so be it. If he becomes mayor, I will call him and offer my help.
Oaktree co-founder Howard Marks says his company actually made a profit from investing in First Brands. He said that they sensed red flags early and made their exit months ago, a rare feat as some of Wall Street's biggest firms actually faced losses there. And Blue Owl Capital co-CEO Marc Lipschultz says Jamie Dimon tying the fallout from the collapse of First Brands and Tricolor to private credit is fear-mongering. Speaking with my co-host Dani Berger at the Case Summit in LA, he downplayed current nerves in the private credit market.
I suppose, like anything, when it's perceived as new, there's always the fear, again, sometimes fanned intentionally by people, but just the fear of, well, like, what don't I know about this thing that now I'm hearing a lot about and I just wasn't familiar with. And by the way, that's understandable. And I think part of the obligation of anyone in this industry is to be part of the education process. Opportunities to sit with thought leaders around finance like you who've talked about topics around this forever, I would say is part of our obligation. For me, it's an opportunity, but it's an obligation to explain. Because it isn't a mystery. It's pretty straightforward, actually, what we do, how it works, and why it works. And I think that's not a small point, which is anything that seems, happens fast, maybe in some ways seems too good to be true. I'm kind of a simple person. I just always step back and say, well, either then you can explain it to me as to why it works and why it's good, or maybe it's just too good to be true. And so I think that is an education obligation. But listen, there are people who have considered this, like meaningful parochial interests in the industry not continuing to grow and succeed. Like the market share is coming from somewhere.
Right.
And the way alts firms have thrived, Blackstone's market cap exceeds the market cap of most financial institutions in the world today. So it's not as if that's not coming from someone, and of course those people don't like it.
Those people might be Jamie Dimon at JPMorgan. Worth mentioning what he said on their earnings call just today, talking specifically about Tricolor, First Brands, which of course the former heavily exposed to JPMorgan is. He said, my antenna goes up when things like that happen. When you see one cockroach, there's more. Everybody should be forewarned at this point. What do you make of his warning?
Well, I'd have to start by making sure I interpret it. So I guess he's saying there might be a lot more cockroaches at JPMorgan, or I'm not sure I know what he's saying. I mean, it's not a private credit issue. I mean, it's a liquid credit market. So I don't, first of all, I'm not even sure I know what he means, but I also think it's like a really colorful way to phrase something, but I don't see the relevance. Let's take First Brands, right? Well, first of all, yeah, there are bankruptcies. There will always be bankruptcies. There are thousands of credits in the marketplace. So I don't know why it's so fascinating, when one happens, but even if it is, let's actually look at that one. It appears, allegedly, that it's a major fraud. I mean, I just don't know what that tells us. Actually, I don't know if that's a cockroach. I don't know why it would suggest there's a bunch of others. I can tell you the facts. The facts in direct lending, but really the facts for Blue Owl, I don't want to pretend to speak for everybody, is our portfolio is incredibly healthy. We are not seeing rising defaults. We are not seeing companies struggling. Of course, there's always a company that has its own problems, and there are always going to be some losses. But it's not as if we don't have, as I said, decades of data on what that looks like. Or if you want to focus on this, putting the word private in front of it, take the last 10 years. For the last 10 years, we've run at an average loss rate of 13 basis points. So approximately over a decade, we've lost 1% over an entire decade. Now, that's low. I'm not suggesting anyone should invest assuming that's the durable result. It's not like it's been calm. I mean, we did go through the collapse of Silicon Valley Bank. Oh, by the way, a bank, not a private credit institution. We did go through COVID. Remember when everyone was in their basement wondering what might happen to the world? Private credit did well. It doesn't mean it's flawless, but it's just an odd kind of fear-mongering. I take it as very sincere by some people, as I just don't understand it. And I understand people have their own business to run, and some people are axed against the product class. But I know from the ground up, and I tend to be fact-based, it's working well. And if anything, to return to where this started, these couple of bankruptcies, both of which are in the syndicated market, what would seem to be the evidence of the problem away from the private credit market. So maybe he might be right. Maybe it's a time for a flight to safety away from the syndicated market to the private market. So I think maybe Jamie and I agree.
Going to check on what's going on in the stock market right now. This is the S&P 500 index, the move screen on the Bloomberg terminal. I think it's the most dynamic way to look at it. And here, one of the reasons you get the breadth. So 400 stocks gaining, 100 down. 4 to 1 is pretty good breadth right now. And that's why you see a gain of 1.1%, adding 75 points back to the index at 67.19. We just continue to head higher and higher throughout the session. Nvidia, one of the big reasons, Nvidia up 1.5%. We're going to talk to the analyst who upgraded that stock to a buy, put a $320 price target. Frank Lee joins us later this hour on why he thinks Nvidia is an $8 trillion company. Progressive out with disappointing results, and as a result, down 9%. Progressive getting absolutely crushed. You can see PNC down as well right now, 4%, as it pays too much for deposits. We've been talking about the banks a lot lately. All of the industry groups in the S&P 500 are in the green here. You can see communication services, those are the hyperscalers up, and IT, those are the chip makers up the most. But everything down to consumer staples and healthcare, down to the defensive sectors, continues to gain. Coming up, BlackBerry helping to power the next generation of software-defined vehicles. We'll talk to the head of QNX. QNX is a division of BlackBerry, and I'm talking about actually BlackBerry, releasing new research on the auto industry. It found software-defined vehicles such as Tesla and Rivian are stalling, and developers have begun to change their approach there. Of the over 1,000 automotive software developers they spoke to, they believe AI-driven personalization will define the industry by 2030. Mattias Eriksson, BlackBerry QNX president, joins us now. And QNX software, if you didn't know, which most people don't, powers 255 million vehicles around the world. That's 1 in 7, by far the market leader. Mattias, thanks so much for your time. Tell us first about the genesis of this business, because even I, as a gearhead, did not know what dominance you have over the automotive software market.
Morning, and thanks for having us. Yes, so QNX has a long history of supporting the most advanced edge compute stacks in the world. We've really doubled down hard on automotive several years back. The main reason being that for advanced edge compute, there's simply no other edge device that has more compute, more sensors, more connectivity, more regulatory requirements. If you want to lead in advanced edge compute, you need to win in the car. We've been very successful. You mentioned the 250 million. We are global. 10 out of 10 the top OEMs are our customers. 24 out of 25 of the top EV manufacturers are our customers. And we also have a significant footprint outside of automotive for advanced edge compute.
So what is the trend? What is the AI-driven trend that you're spotting? How is that going to look in cars that we buy in 2030, 2035?
Yeah, so as you mentioned, we have done a survey for embedded software developers in automotive. There's lots of feedback in that survey. AI is one component. Maybe hit that first and then come back to a couple of the other components. Essentially, what developers are telling us is that they believe AI and software development for advanced software-defined vehicles could, from their perspective, replace 30% of the workforce long term. I think a simple survey like this, you shouldn't over pivot on that number. The reality is that with regards to automotive software, there is a significant backlog for the automotive industry. And if AI can drive significant productivity improvements, I think that would deal with some of the other challenges that the automotive industry has with regards to software. Long development cycles, significant recalls, significant program delays, high complexity when it comes to integration, et cetera, et cetera.
What are you doing to reduce that complexity, Mattias? Because, during the supply chain crunch especially, a lot of automakers complained about the fact that these products come with thousands of chips. Does it stay that way? Do we get even more chips in cars, or can you reduce that in some way?
Yeah, so multiple components to that question. Let me start with the basics. So simplistically, the automotive industry is on a multi-year journey from a very decentralized compute architecture to something that at some point will be wholly centralized high-performance compute. You know, there were hundreds of ECUs in the car for many years. That is being centralized into compute stacks that have much more compute capacity. Think centralized digital cockpit, centralized ADAS, et cetera, et cetera. And throughout that journey, software gets a larger and larger portion of both the value creation and value capture. What we are trying to do is to help OEMs, automakers, players in the value chain that are building these next generation stacks to accelerate their time to market, reduce cost and complexity, increase safety and security and reliability by allowing them to take away the foundational software in that stack. We're a foundational software provider. We build the bottom of those advanced software stacks. Think of us as the plumbers of advanced edge compute. And if you don't have to build all the stack, if you don't have to deal with hardware-software separation, all the plumbing, you can move faster and drive innovation in a better way for your end consumers higher up in the stack.
Is there a difference, by the way, between the highest end and you know, your run-of-the-mill $40,000 car? We're going to talk later on today with Benedetto Vigna, the CEO of Ferrari. Does he do something, you know, different for a $400,000 or $500,000 car than maybe Honda does for a $35,000 Accord?
There is a massive difference, but it's not directly correlated to price. So depending, I mean, obviously Ferrari is a high-performance car. They do a lot of really cool stuff. Software is not their focus for digital cockpit, I would say, compared to, for example, an EV startup. But there's a significant spectrum of complexity with regards to software across different auto manufacturers. So. A modern car, we used to talk about 100 million lines of software code in a car. There are cars launching today with more than 500 million lines of code across multiple compute domains. You can imagine managing that, updating that, and making sure that the consumer has a great experience.
Mattias, one final question. Competition. I mean, you haven't got much. Right now, there's, like, Android has the second most significant share, I would guess, and then Linux and some open source stuff. But everybody else, there's got to be sharks in the water, right? What do you do to fend them off?
Well, so first of all, it's a common misconception that we compete with Android. Google is one of our great partners. When you have an Android stack implemented in the car, we actually sit underneath that stack. There are multiple operating systems in the car. There are multiple middleware layers. We sit underneath Android, and we have by far the best implementation of the interfaces to the Android software stack. In terms of competition, quite frankly, the biggest competition is the legacy architecture and the challenge of moving from that legacy architecture, decentralized compute, to the nirvana of high-performance compute. There have been, as you don't need to tell you, you're an automotive guy, there's been significant delays in programs, there's significant challenges. Our biggest competition is they stay too long on that legacy architecture.
I'm happy to have you tell me as much as you can, Mattias, because I am always learning. Grateful for your time. Mattias Eriksson there of BlackBerry QNX. Let's get a check now on what's going on in the stock market. We're looking at continued gains here. As you saw earlier, really strong breadth. 4 winners for every loser on the S&P 500. A gain of more than 1% there. The NASDAQ up another 350 points today to 24,929. So getting back towards the 30,000 mark. Let's get a look at some of the single stocks moving this hour. Rare earth stocks are actually down today after Treasury Secretary Scott Bessent said that China tariffs could be delayed in return for a delay on rare earth export controls. And then you see Stellantis. It's vowing to invest $13 billion in the U.S. over the next years in an attempt to reinvigorate. This is, by the way, another one of those companies that uses QNX software to reinvigorate its business and mitigate tariff costs. Stellantis up 1% at $10 a share. And HSBC's Frank Lee upgrading Nvidia to a buy and raising his price target to a street high of $320. Hitting that target would translate to a market cap of almost $8 trillion. and I believe this is a 12-month target. But don't take my word for it, because Frank Lee himself joins us next on the program from HSBC. In fact, he's here right now. Frank, great to have you on the show. Isn't it just mind-boggling to think that this company could nearly double in market cap over the next 12 months, given that it's the biggest company in the world?
Yeah, look, I think the numbers certainly seems, from a market cap, seems it's quite unbelievable. But what they're doing in terms of their ability to deliver on revenue and earnings potential, it just continues to surpass expectations. So I think one of the reasons, we've turned more bullish is based on what we're seeing for next year. I think the whole narrative is starting to come through. I think the last couple of years, it's really been tied to hyperscaler CapEx spending. But as we start to see this year, we're starting to see more signs that the TAM opportunity is really increasing beyond just the 4 or 5 hyperscalers that we've seen over the last couple of years.
Don't they, because of the boom in AI over the past, let's say, 3 years, and Nvidia has been kind of the only player in town in terms of training models, don't they see increased competition fast from Broadcom, from AMD, and from the Chinese?
Yeah, I mean, I think, earlier in the year, especially in the first half of the year, there's a lot of debate about, within the hyperscalers, the ASIC opportunity was booming. Broadcom, which is a stock that we like tremendously as well, we continue to see they gain strength to strength. But I think what has changed is really, the narrative is that the opportunity is not just hyperscalers. We've seen a lot of strength with NeoCloud. We've seen sovereign. I mean, this is something that Jensen has been talking about since the beginning of the year, but it is starting to happen. We see, Stargate is a good example of sovereign AI really starting to take off. And I think, when we also see is, Nvidia is also getting more bullish about their forecast to TSMC going into next year. And, we haven't really seen this momentum accelerate for almost a year. But as we go into next year, that number looks like it's starting to get stronger again.
A huge part of the TAM, of the total addressable market, Frank, is China. To believe in $320 a share, do you have to imagine that we have some kind of positive outcome to this trade war?
I think certainly from a sentiment point of view, it will make a difference. And even regarding that, we do believe there could be some opportunity to see some improvement. We went into August cautioning investors that China would not be as easy just because Nvidia is being allowed to get into the China market. And that's proven to be, I think, correct, that Chinese are not really moving to Nvidia as quickly as expected. But we do think, once the trade deal gets done, and that will start to improve. Nvidia, we expect, will have another chip that will be geared for the China market. But realistically, though, we don't need China to really be a big part of the story. I think if you look at the recent OpenAI deals, just looking at the gigawatt that's been committed, that potential market size could almost double the Nvidia data center revenues of $300 billion from next year. So that, now, of course, the timeline for that is going to be it's going to take some time, but it does show you that the TAM potential is there.
The gigawatts is still something I'm trying to figure out in my head, right? I think Manhattan, to power Manhattan, you need, 7 or 8 gigawatts of power. You point out from OpenAI and Stargate alone, they have almost 20 gigawatts of exposure here. What kind of total do you expect in terms of gigawatts of power needed to hit, $8 trillion Nvidia next year?
Look, I don't think we expect that it'll be overnight. But we do think that one of the challenges and the focus for the market will probably be sometime around mid next year. We're going to start to look at the power part of the story much more closely. Stargate project really starts to kick off in the second half of next year, but it's not of scale yet until 27. So I think we have about another year before the power issue really becomes a crucial bottleneck. So I think we'll have to continue to see over the next year, how the power infrastructure builds out. But if you believe, the whatever OpenAI has committed right now, then the market potential truly is quite big, and it could potentially double Nvidia's revenues over the next few years.
Frank, great to get some time with you. Really appreciate you stepping on the program with us today. Frank Lee there of HSBC, the Hong Kong Shanghai Banking Corporation, coming to us out of Hong Kong. Coming up, BlackRock and Microsoft inking deals as the AI data center race rolls on. In fact, not just any deal. the biggest data center deal of all time. We'll talk about that next here on Bloomberg Open Interest. Infrastructure has emerged as a major theme for investors betting on the AI boom. It's been that way for years, but today we saw BlackRock buying Aligned Data Centers in a deal valued at $40 billion, including debt. Microsoft cut its fourth deal in 2 months with data center developer Nscale to build a new site. And ASML is just selling a ton of its incredibly complex lithography machines to make high-powered chips for these power-sucking data centers. For more, I'm joined by Peter Elstrom, Bloomberg Executive Editor for Global Technology, and Anurag Rana, Bloomberg Intelligence Senior Analyst. There's a lot to cover here, gentlemen. I appreciate both of your time, but let's start, Peter, if we could, with the ASML story, because, you know, these are the people who make the chips for the people who make that make the machines for the people who make the chips. So they're kind of the starting block in a way, unless you count the designers. What do we know about their order book?
Yeah. ASML, as you say, sits at the beginning of this supply chain. They make the most advanced lithography machines to be able to sell to TSMC and Samsung and Intel, et cetera. So we got earnings from them today. The revenues for the quarter were a little bit light, but they talked about bookings, too, and about how bookings were much stronger than analysts expected. They said they were 5.4 billion euros. Much ahead of the 4.9 billion euros that analysts had anticipated. And they signal that this AI demand is really strong right now. They're very optimistic about the future. The CEO, Christophe Fouquet, just had a conference call where he talked with analysts about what the demand looks like and how they're making progress in this field. So they're signaling that they are optimistic about how things are going to go from here, and they're looking to capitalize on this building boom that we're going to talk about. Yeah, so they are going to build these machines, send them, as you say, to TSMC and Samsung. They get orders from Nvidia and AMD and others, Broadcom, who are going to make these chips and put them in these giant warehouses, right, Anurag? And I guess Aligned Data Centers, which BlackRock is buying with a bunch of partners, is going to run like 78 of these data centers. How far along are they in developing those?
So, you know, when you look at the data center space right now, everybody has this massive bookings. Everybody is getting new orders, but it's very difficult to convert that into revenue. So there's a big race right now to either, you know, lease, build, borrow, anywhere you can find capacity where you can, you know, place the chips, place the servers, and then, you know, execute on those big orders that are coming in.
Yeah, it's all happening so fast, right? I mean, BlackRock just bought GIC last year for $12 billion. Now GIC is teaming up with a bunch of other subsidiaries to pay $40 billion in total for Aligned Data Centers. Peter, is there, I mean, there is a lot of skepticism, but what are the points that the skeptics make about this boom?
Yeah, well, I think one of the big questions that we're getting is how these new financing vehicles are being implemented. And we're seeing it in a number of the deals. Nvidia's partnership with OpenAI, for example, also OpenAI's partnership with AMD. What you're seeing is new financing being created on the fly, really, to be able to finance some of these enormous deals that we're talking about. It's not just tens of billions of dollars, it's really hundreds of billions of dollars that these companies are planning on spending. So you see Nvidia giving cash to OpenAI, which is then going to buy Nvidia chips from the company. And these kind of circular deals are raising questions. Are they self-perpetuating? Are they eating the tail of the beast to be able to prop up the valuations here and be able to keep the revenues growing? Now, what Sam Altman and some of the other champions of this AI boom would say is that we need new financing vehicles to be able to meet the kind of demand that we anticipate in the future. So they want to build while they're able to raise the money. They want to raise money wherever they can, and then they want to build these data centers. They're talking about 10 gigawatts of data, in some cases another 6 gigawatts of data with AMD in particular. So they want to build as quickly as they can.
Well, and they're all sharing the bill, right? I mean, BlackRock subsidiary GIP already owns a data center, CyrusOne, with KKR, but now they're going to create a new subsidiary, AIIP, with Mubadala and Kuwait. And Anurag, how many people are in this consortium that's going to buy Advanced Data Center?
See, if you look at from the financing side, everybody wants a piece of this. But when you look at somebody like a Microsoft or a Meta, they will go anywhere they can find capacity right now. The biggest issue for them is they actually have the cash, but they don't have the ability to run some of those transactions that are coming in. I think look at Microsoft's case. Their backlog is so strong, above $300 billion. And now they are, trying to figure out how they can recognize some of those bookings into revenue.
Are we using all of this compute, Anurag, or are we going to be using it all by the time they're done building it in 2030, 2035?
So Matt, the way I put it down is I put it in two buckets. The one bucket is all the hyperscale cloud providers that actually have the cash that they are building some of these data centers. OpenAI is slightly different because they have a very high projection of revenue coming in for the next 3 to 5 years, and they are making the bet based on that based on the demand that they have seen so far, and if they extrapolate that going forward with enterprises with more consumer cases, they are confident that they will generate so many billions of dollars down the road, and they will use the funds based on that revenue stream to fund some of that stuff. So there's two different.
As of now, Peter, these, at least the public companies, they're making money, right? Bottom line. I mean, there's so many comparisons to 1999, but it's not just churning revenue. They're actually producing earnings.
Yeah, Anurag makes an important point here. There's a distinction between companies like Microsoft, which have the balance sheet to be able to finance what they need to finance. They're cutting deals with Nscale. They can make that deal happen. They've got the billions of dollars that they need. When OpenAI cuts a deal with Oracle and they talk about spending $300 billion on data centers over the next few years, they don't have that money. Oracle doesn't have the ability to build those data centers, and OpenAI doesn't have the revenue today to be able to support that sort of thing. They're really betting on Sam Altman being able to build these services substantially into the future, and they have a long way to go. Just to be clear, OpenAI's revenues last year were about $3.7 billion. They're aiming for $13 billion this year, but they still have a long way to go to be able to finance $300 billion in data centers, never mind the full $1 trillion in data centers that they've talked about so far.
All right. It's such an incredible story that we're all seeing. We're watching history being made here, gentlemen. Probably for the three of us once again. Anurag Rana of Bloomberg Intelligence and Bloomberg's Peter Elstrom. Later on today on Bloomberg Markets, we're going to hear from Liz Mueller, CEO of Deep Fission. That's a startup that's pioneering a new approach to nuclear power. Catch that interview at 12:30 p.m. New York time. And we're going to need all the nuclear power we can get, I guess, to run all of these data centers. This is Bloomberg. This is Bloomberg Open Interest. I'm Matt Miller. Let's get a quick check on stocks. About an hour and a half into the session, we're looking at an S&P 500 that's up a solid 1% there, 6710. The level on that index, I believe 6753 is the closing high. So we're getting back there. NASDAQ 100 up at 24,900. In terms of the big stocks, the biggest stocks moving, Nvidia right now up 1.5%. And ASML we were just talking about. The bank index is doing well with beats out of Morgan Stanley and Bank America. The regional bank index, though, is off. Tesla gaining, even though Jay Hatfield says it's the only one of the Mag 7 in a bubble. And Stellantis, maker of the Dodge Challenger, up 1.25% after saying it'll invest $13 billion in the U.S.